welcome everybody to the breakout session on growing your portfolio in today's multifamily market. My name is Brent Mott. I've been investing for about 10 years, kind of across asset classes. In the last 3 years, transitioned from single family residential to multiple different commercial asset classes. But wanted to welcome our panel and thank you for coming. So let's just have everybody introduce themselves, talk about what they do in their business. And what their business model is. So Jorge.
Hey everyone. So my name's George Abreu or Jorge.
Sorry.
It's either or, can't go wrong. Been in real estate for about 15 years now. Started in single family as well. Transitioned over to large multifamily syndications about 4 years ago after doing quite a bit in single family. Scaled up the single family, started a construction company as well. That was about 11 years ago. And transitioned both the construction and investing into multifamily. We've got a little bit over 2,500 doors right now under management, another 1,000 or so under contract, and in growth mode.
I'm pretty sure I'm not going to mistake how to pronounce Chris's name. So Chris?
Good morning. My name is Chris Ragland. I'm independent now, and that's kind of different and nice, but I guess I'm actually the old guy on the panel. I've been in real estate investing for 22 years now. And during that time, I've bought and sold a number of companies. I've probably worked in almost every facet of real estate investing. I know that sounds kind of strange to say, but it's been a really interesting career. So now I tried really hard not to work anymore. And that lasted about 6 months before my fiance told me I had to either move out of the house or go get a job. And so I started investing again. And now I work with family offices. So I have a few family office clients scattered around the globe, and I help execute their real estate and their small balance private equity strategies. I'm based primarily out of Austin.
Great. And Kaylee, the apartment queen.
Can you ask the question one more time? It's been a minute.
Kaylee, if you can introduce yourself and just kind of tell us a little bit about you and what your business model is and what you're doing.
Oh, it's not working? Okay. So I'll try to project a little bit. So I'm Kaylee McMahon. I'm newer in the business. So I've been in real estate for 4.5 years, and I've been doing multifamily for 3. I've done value add, that's it, C-class workforce housing, repositions, and currently in growth mode, trying to catch up to these guys. So I'm, I guess, the newer one on the block. And so some of the things that we employ as far as our structure and things that we do a little bit differently, I'm really excited to announce that we actually have a fund that's launching next week. It's going to be a side-by-side offering with regulation crowdfunding. So in addition to the fund, which is for accredited only, now we're going to be able to expand our model to lower the barrier to entry for women to be able to invest in real estate and especially apartment asset classes. So that's a little bit different. And then also what our mission is, I'm working on some standard operating procedures so that we can train teams of women to be able to have boots on the ground in different states and areas. So that's a little bit about me and how we're different and what I do.
Okay, great. So thank you so much, panel, for introducing yourselves. So we're in a interesting time. I don't know if anybody is aware of that. The world has changed in the last year. I'd love to know, this is going to be kind of a 3-part series of questions. And one, I don't want to plan our entire business around the pandemic. So first question that I'd like to ask is, what was your business model pre-COVID-19 when the world was open and when things were moving around? So what was your business model pre-pandemic?
I can start. Yeah. So pre-pandemic, we leverage the construction company quite a bit, and we go after heavy value add deals, like true value add. That was our main focus pre-COVID. When COVID hit, that was with the bridge lenders pretty much disappearing. That became very difficult. I don't know if you want us to jump into what we're doing now or just leave it at the pre.
So let's start off with what we're doing now, because let's not get ahead of ourselves. We don't want to get too excited. But just for the people that are maybe in single family now, both of you have mentioned value add repositioning. Can someone describe what that means and some of the terms that we've used?
Absolutely. So these properties, when we say it's a value add, it's going to be a property that hasn't been upgraded recently. The rents are under market. The management isn't managing it correctly, or expenses are just through the roof. So there's a lot of potential in that property where you can easily come in and add value to it by upgrading it, raising the rents, taking care of the expenses. So a lot of CapEx goes into that, which is pretty much the construction and the upgrades. Basically covers it.
No, I'll dovetail into that. So pre and post COVID and the changes in value add, talking about it. So for us pre-COVID, we were picking up a lot of multifamilies that were either stabilized or were long-term opportunities for value add projects, but we weren't necessarily purchasing a property with the intention of doing a massive renovation and repositioning the rents and the market and with that property. And we hold everything. We don't actually resell anything, which is also probably a little different. So for us, and the market was so strong, and the rents were already really strong, occupancy was really high, right? So everything was great, and it was just like the cash flow game, right? So then COVID hits, and what happens? Start having, delinquencies. You start having people move out. You have a lot of people that you can't, forcibly remove from your properties because of moratoriums on evictions and so forth. So for us, we looked at it opportunistically. So we said, okay, let's focus on a few properties that are actually value add opportunities that we just weren't prepared for because they were fully occupied, and let's try and vacate the whole building. So what we did is we doubled down and started going very heavy on value add. We took some properties that we knew we had maybe some college kids and there was a big fear factor, and we said, tell you what, we'll let you out of your lease. And everyone started signing up. Thank you, thank you, thank you. I'm out of my lease, I'm out of my lease. And we took entire apartment complexes, usually on the smaller kind of vintage side, like 50 units and below, and vacated them out. Even gave incentives to the last people that were there. It was like, here's $1,000, get out, right? Like a cash for keys almost, right? So we got rid of all these people, which then allowed us to do something else, which if you have a strong balance sheet right now, which was really great, is we actually went to banks and got rock bottom pricing on construction loans to now do a full renovation on these projects. So a true value add, but an opportunity that you just normally don't get. Unless you're buying a kind of a dead apartment that's completely vacant, it's really hard to time the rents and get everybody out, and then you're sitting on your debt service and you've got that last 3 or 4 people, and maybe you start construction and someone's inside and it's just really annoying and they're complaining because you're making loud noises. It's awful, but we use the pandemic as an opportunity to transition and move some of these properties into a value add category that maybe weren't there before. So that was probably the biggest change for us.
Great. That's one of the things that I love about real estate and real estate investing is you can pursue different opportunities regardless of what the economy throws at you. Kaylee, can you tell us a little bit about your business model pre-pandemic?
Yeah, so pre-pandemic, just kind of how y'all were saying, it was a cash flow game. The market was crazy, crazy good. So I was able to be comfortable buying in Dallas-Fort Worth, for example, in areas that were C-class, and that was okay. However, that changed drastically when it came to the pandemic, what market I wanted to invest in, and why, and what type of tenant mix we wanted to go in with, trying to change the strategy. Normally, exactly like that, you'd be like, oh yeah, we're just going to totally change the tenant mix, and we're comfortable with having everybody not renew. That's fine, and then post-pandemic or in the pandemic, that was very different. We wanted to keep it, we wanted to keep people. So that was one of the things that was different beforehand, was the type of neighborhood that we invest in. Then also the type of leverage that you get, lessen the leverage partially by force. Our leverage had to decrease a little bit, and also increasing, or we had not as much reserve as we did now. Even when we do bank debt, we'll do an extra amount of reserves that can't be touched for a year, just to make them feel more comfortable. And then we have an extra, slush account. So beforehand, we didn't have the extra, 2,000 per door extra reserves. It was just like the per door bank required $250, $350 a door. So I guess that was the typical change all the tenant mix and raise the rents kind of thing. And that rent increase that normally keeps up with inflation Now it's very different when I'm underwriting something. So that's another thing that before it was like, oh yeah, this is a reasonable amount of rent growth, and now it's different.
Okay, perfect. So for those of you that are in the single family space, thinking of transitioning, one of the major differences between single family, multifamily, commercial is the way that the property is evaluated. Okay, so a single family residential property is based off of the price per square foot of the property, whereas a commercial or multifamily property, the value is based off of the net operating income. Essentially, how does it operate based as a business? So when they're talking about going in, increasing rents, decreasing expenses, they can go in and grow that net operating income to grow the value. So we've got, so I know, Chris, you do a buy and hold model with yours. Do you reposition and sell? Do you reposition and hold? What is y'all's model?
We do 5-year projections. So plan is to come in, force that appreciation with the value add, and then sell within the 5 years.
Yeah. So what do we do now? Or what did we do? It's changed a little bit.
Okay.
So in the past, it was like get in, get out, quick flip, depending on the type of market too. So if I was doing secondary, tertiary, get in, make it look nice, get out. Now looking at the way that we set up our PPM, because you have to set it up correctly from the beginning. If you're going to refi, whatever you're going to do, you got to set it up one time. To where we're more open to a legacy hold type structure, depending on what the exit projections are, depending on the types of investors that are interested in getting involved in the deal, depending on the raise amount. But being able to recap is something that I've been approached a lot about recently in this time period where maybe you have something that's working well, it's cash flowing. So thinking of that on the front end, opening up that possibility in our offering where moving forward that we can recapitalize and keep the property. So it's changing a little bit.
That's a good point, what she just brought up. When you're doing a raise to take down a multifamily, one of the things that I think we are seeing from COVID, and again, I've been through it long enough now to have gone through it in 2008, and then I went through it again during the .com bomb, that a lot of the offering documents, when you're putting them out, if you've kind of pigeonholed yourself into a specific strategy, it can be problematic during a black swan event like COVID, right? Because now you're having to go and you really want to do something that really your offering documents don't contemplate. But it's the right thing to do. So now you're stuck with like, okay, I have to notify my investors. What kind of, ambiguity is this going to create with them? Are they going to, get shaky and want to redeem early? All these kind of problems that can occur.
And every single one of them has to sign off.
And yeah, exactly. And if you're taking a significant, strategy change, you really got to get them to sign off or you have significant risk with those investors. So it's really important when you're thinking about drafting your offering documents that you give yourself some flexibility. Now on the other hand, too much flexibility in your offering documents makes it harder to do the raise in the first place. So it's a balancing act there as well.
Perfect. So you bring up raising funds. Kaylee brought up crowdfunding and bringing in new ways. How do you work with your private investors, and how do you raise your capital? And then what is your communication style with them? When you need to make these pivots?
Can I just start off by saying something that I've been doing this for a long time, and maybe maybe you're the one that gets the credit here. I have never seen so many women in a room before in this investment class. So kudos to all of you for being here. I just think that's really amazing. So that's crazy. I don't know if you know, but I did the count, and it's like 50% in this room right now.
Yeah.
So you guys are dominating in a space that never happened. So good for you guys. So anyway, I just had to start off by saying that. So I think it's probably you.
You rock.
Well, clearly you have a crowdfunding strategy, and it sounded like your call out was helping empower women and educate women on how to get involved in this type of an investment asset class. And I think that it's really amazing that there are people that are going out there and deliberately making that part of their investment mandate. And it sounds like that's what you're doing.
Yes.
Maybe tell them about it.
Even part of the fund. So there's not the regulation crowdfunding side, but the regulation D 506C side. That one, it's a female-focused fund, and we're targeting COVID-19 affected properties in secondary markets, because that's where I'm starting to see some opportunities. And the men that invest in that fund, there's an opportunity for them to be able to pick a female mentee or multiple and then put them on their subscription documents. They also have access to that person's account, separate user credentials into our portal. every quarter they put a little report summary of how their mentorship is going, what they're learning, risks, rewards of what we're doing. And if the mentee can keep that up for a calendar year, when they get paid out their preferred return, which is 7% for the fund, those men will actually get 7.25%. So we'll kick up their returns if they make that effort. Because I mean, I have the power to be able to empower more women. And like if I plan it that way, or if I can, why not? So that's part of that. Yeah.
I think that's amazing. So with the recent changes that the SEC just put out that really increased the cap on crowdfunding facilities from 1 to 5 million, that's really making this type of an investment possible through crowdfunding. So if you are looking at raising capital and you want to do it with non-accredited investors in a crowdfunding sense, and you're also trying to do it in multifamily, it's now realistic. When it was $1 million, it's really, really difficult to do anything. But with a $5 million cap, now it's realistic. So talk to your attorney about that. I'm not an attorney.
Same.
Right. There you go. Huh?
I'm not an attorney.
Okay, so there you go. There's our disclaimers for the camera. But I think that, for us, we raise capital a little bit differently. So I mentioned earlier that we're working with family offices. So that isn't to say I don't understand the fundraising process. At my previous company, we rolled out some pretty large funds. I think by the time I had left, we had done it maybe 8 or 9 different times on different very large funds. Some of the facilities as large as 250 million. So the idea though on raising capital, particularly for people just making this transition from single family into multifamily, if that's who you are, actually I'd ask for a raise. Who's thinking like that's something you're actually interested in? Is there anybody making a transition? So maybe like 5. How many of you in here are already in multifamily? Okay, so that's the audience. We're talking to people that are already in it. Great. Well, if you're looking at expanding your fundraising activities, I would definitely go back and revisit the crowdfunding. Also take a look at some of the changes the SEC just made in terms of who is an accredited investor.
12 million more households were created that are accredited.
Yeah, overnight. It's just a regulation change. Imagine that. So anyway, there's a lot of ways to go back out and retarget investors who previously you weren't able to solicit directly, specifically with a Reg D 506C fund, right, where you can openly solicit. So go back and look at that and say, hey, who am I not targeting today that I can now because of these regulation changes? So I think that's something that a lot of people have missed an opportunity on.
And the cap on accredited investors, what they can invest, is now there is no cap. Used to be 10% of their liquidity or something like that. Yeah. But now it's whatever you want to spend. So that's cool.
Yeah, it's really cool.
As far as us, we do a bit of both. We do work with family offices and private equity firms on our larger deals, and then we also do, your basic reaching out to high net worth individuals or just individuals that want to invest passively. I'm passionate about getting that out there because myself, even being in the single family 15 years ago, I wasn't aware of the fact that you can invest in multifamily and receive that passive income. Would have been huge, especially on the taxes as far as the depreciation goes. And if you can claim you're a real estate professional, I'm not going to go deep into that, but there's a lot of tax savings that way. So just getting the word out that, hey, you don't have to just invest in stocks, or you don't have to just invest with your retirement plans. You can actually invest in real estate, and the returns, if you're with the right group, can be amazing.
Perfect. Geographically, do you have a particular focus where you look geographically, or is it just where the opportunity is?
I'm very where the opportunity is, where the deal is. We're in Texas, Oklahoma, South Dakota, Georgia, possibly Florida soon. So pretty much where the deal's at. We feel very confident in our systems that we've created, and we can easily mobilize in an area and manage properties.
Yeah, we're very open to where the deal is. Obviously, I'm biased towards Texas because I'm from here. My fiance and I also split time in Mississippi, so I do a lot of deals there, but we do deals globally. So I have deals in 4 other countries even, which is a very different thing. I don't recommend doing, actually. So we put that out there. But yeah, we work a lot in Texas, Mississippi, Georgia, Florida, New York, Utah, California, and New Mexico. Those are probably, and New Jersey. Those are kind of our core areas, I guess. There's not a core anymore, obviously.
Where the deal is 100%, but it also has to coincide with the market that's landlord, business, and tax friendly. I mean, if it doesn't, I'm like, you'd have to get the deal of a century to do something in a non-landlord friendly state. So.
She is nailing the head on that for sure. Like we may do deals in New York because we have family office money from New York.
Yeah.
That's the only reason. If the money wasn't there and they didn't have the experience because of the way the laws are in New York or California, I'm like, no thanks. Why waste the time when I can go do a deal somewhere else?
People that want you there, and they'll pay you to be there.
That's the only answer. If they'll pay me money to go there, okay, fine, let's talk.
Exactly. So we talked about what we've done pre-pandemic, during the pandemic. I'm optimistic. I'm optimistic. I think that anybody that tells you that they know what's about to happen, check their crystal ball, because I don't think anybody knows what's going to happen. What do you see happening in the market and the trends of what your crystal ball says, and what are you doing to prepare for that?
I do not. And I'm famous for telling people that if someone tells you they know what's going to happen, leave the room, right? That's the wrong room to be in. If someone's on one of these panels telling you exactly what's going to occur, wrong room to be in, wrong speaker to be listening to. For that point being said, I look at a lot of data, right? So to me, that's the only thing I care about. And then because I'm now the old guy and having done this for 22 years, like I do trust my gut a lot because I feel things and I don't know why. And it doesn't make any rational sense whatsoever. But a lot of times I'm like, this feels a lot like something I've seen before. So I'm okay, let's move forward. And that doesn't make sense. So don't do that. But the data that I'm seeing is showing significant increase in new lease applications in a lot of areas, particularly college-focused areas. I also sit on the board of trustees for my alma mater, so I get to see a lot of interesting data from around the country that is indicating that the experiment of your kids being back home in your home at a college age is really not working out for people, and parents are basically saying you're going to college and not in your bedroom here at home. So the data is showing a tremendous amount of return to on-campus living. The data is showing a tremendous amount of people putting in applications for even as soon as this summer. So we're seeing like a significant increase in people returning back to apartments, particularly at the student level, right? Conversely, we're seeing no uptick whatsoever in kind of blue collar, lower end, lower rent reapplications. I'm seeing like that's just been flat. It's just really rough to be in. So if you're in kind of like a B- kind of thing and you're really getting great cap rates and cash flow on a property, and if they were having problems during the pandemic, they're probably still having problems. We're not seeing a lot of change in that asset class. So if that's where you're playing, it could still be rough for a little while longer. And then the luxury side, I actually don't play in, so I don't have a lot of information on that side, just being honest.
It's a pretty good crystal ball.
No, and I don't know what's going to happen. There you go.
As far as what I think is going to happen, or, I'm very data driven as well. And, I see properties, C-class properties trading for very high per door price, and going through 2006, 2008, whatever, the bubble, I've been through a market cycle, and my gut is just telling me that some of these things are just trading too high, and that exit is going to be an issue, especially depending on how it's structured for the long term. If it's for the long term, that might be a different story, but a lot of syndications are structured in that 5-year term. So we don't feel comfortable paying these 120 a door, 130 a door for a C-class property, even though, I'm talking about maybe Dallas or Phoenix is even higher than that now. But the data's there in those economies still, that it's showing the growth, but I just don't feel comfortable with that price. And maybe it's also the fact that I do new development as well, and I know what it will cost for some of these properties, and it's kind of just crazy to pay for something that was built in the 70s that same price. With that said, so we're back to looking for those true value add deals, the ones where we're coming in at a low basis. I know I can force that appreciation. I don't have to just sit back and hope that appreciation happens and that I can exit this property. I know I can force it by driving up that NOI.
Kaylee, what do you see happening and what are you doing to prepare?
Crystal ball. So let me consult. Let me see. So I've seen particularly Arbor Mortgage having some issues with their loans being over leveraged. So there's people that are in pre-foreclosure specifically from them. There's a property here in Houston we go check out that's they've been in forbearance for quite a while and they're not in a great position. So I've seen some of that. I think that's going to continue to happen because people have kicked the can down the road. They didn't have adequate cash reserves in the first place. Like I mentioned earlier, that was something that before distributing any money, we made sure that we held back extra, so I think that that's an opportunity that will be kind of a rolling coming up as they come, depending on how ill prepared people were with their cash reserves and their debt and leverage. Then also what the world's top 7 economists are saying is that by 2023, there's a chance that real estate values decrease to 50% of what they are today. So I'm not saying that that's for sure going to happen, but if that does happen, exactly what George is saying, with buying it at the right basis, you can't lose. You know what I mean? If you buy it in at the right price, like how do you screw it up? You know what I mean? So being able to find true value add deals in distress and vacancy, things that someone else can't fix. You got to find the story, but that's where I see the opportunity continuing. And so like I mentioned, I'm seeing that right now in secondary markets because you have people like living in their building and like, hey, yeah, my brother's got a unit, he lives there for free, just not professional. So I see those opportunities coming, in the next year. It'll increase, I think. Yeah, a couple different things.
Great.
To prepare for it, to answer your question, sorry, the fund is definitely targeting those types of assets. And having, cash up front to go to a broker and say, hey, I've got $5 million, let's get into it, may even get us a better price. And then we can go in and leverage it. So.
Wonderful. So our topic is growing your portfolio. Can you tell us about your acquisitions model and where you're looking and finding deals?
So we're looking in secondary markets. We're actually big into Houston, which obviously is not a secondary market, but for some reason it's been, not for some reason, I think a lot of it is oil, and then you had Harvey. So a lot of that has kept Houston pricing kind of low. But it's still the 4th largest city in the US, and it doesn't seem like it's slowing down as far as population growth. So I feel like there's a lot of potential here still. Outside of that, mainly secondary markets within Texas and other landlord-friendly states. Like Ken said, yes, it's got to be landlord-friendly.
That's what saved our ass during the pandemic.
Yes, absolutely.
But, sorry.
Can we edit that out?
It's live.
And then,
No 5-second delay.
yeah, he's the one that cursed this. We still got some left, so I don't know. Let's see what happens. And then the true value adds. I stick with that. I think being able to force that appreciation is huge, especially where we're at right now. And then being very specific in the areas. I know we're talking about Houston. Well, not all of Houston. Go and look for the micro areas that are really performing well and have performed through COVID for different reasons, mainly because usually it's employment. Wherever that tenant base is employed has stayed open. And yeah, that's what we're sticking to, and that's how we're growing our portfolio.
Try and give you something different. I totally agree with secondary markets. I totally agree with value add. Those are the home runs. What we're finding, and I think this is just experience after a while, what I want you to think about is open up your eyes to the surrounding area to your property, okay? And really what I'm getting at, if you already know how to do this, great, but I'm talking about assemblage for other types of opportunities in your area. I think most investors, especially if you're not living in the area that you're investing in, you'll tend to look at a property real quickly, and then everything else starts to be spreadsheets and analysis and underwriting, and you're not really understanding the neighborhood and what's going on in the adjacent properties. Okay, I think that's very common, very normal, but I want you to take a little extra time in your underwriting and try to learn what's going on next door, because there is massive opportunity if you really understand your adjacency. So I'm going to give you an example on something we're doing right now. We found a package of apartments. Many of them are next door, but not all of them, in a real small little tight area. And it's got an assumable Fannie Mae note on it in an interest-only period. It's really wonderful cash flow, looks great. And that's the end of the opportunity from the broker who brought it to me, right? He was like, this is great, good cash flow, let's pick it up, it's assumable, y'all are great. Okay, so I go and look at the property and I say, well, first of all, one of the buildings is way over here on its own, okay? So it's kind of a different property. And then all of these other three are right next door to each other. And there's a commercial building over here that I'm pretty sure for the right price we could purchase and gain access to the major road. And by assembling all of this, theoretically, if I wanted to, I could demolish this and build something that's got much better access to the road. There's a density overlay in this area. Like, we could really do, and they're just looking at me like, okay, yeah, we didn't even think about that, right? This is all new. And it's not. It's just the next level. So I want you to start thinking, what else is going on around me? So fast forward in this story, Fannie Mae and the bank behind it, of course, the originator is allowing us to come in, assume the note. I said, hey, can we get a new loan and carve out this other apartment? And then we're going to take this guy back into a value add. So a very traditional value add project. Then once we get it back up online and we have the cash flow to support, I want to come in here and instead of doing a value add, I want to demolish, acquire this other property and build a brand new 300 unit development over here, right? So it's a very, very different project now that we're looking at it than what it was when the broker thought he had it teed up and gave it to me on a platter. So don't forget about assemblage. Don't forget to look next door and seeing what's going on, because it could change your analysis. It could change what you're going to do.
What was the question again?
What is your acquisition model, and how are you finding your deals?
Finding deals through relationships. I mean, 100%. I'm looking at expanding that pie a little bit as far as relationships through other organizations where they're closing 300 million worth of deals a year, and they've got a lot of trash that they don't want. So that's another strategy that I'm looking at employing. As far as acquisitions is the toughest part for us right now, because as you can see, as I mentioned earlier, I'm one of the newer people at the table, and so when people are looking at your track record, we're only at 780 doors, and that's with other partners too. Me being lead, I'm only lead in 3 deals, so I'm growing, but I think they get more excited the more you close, the more that you do. So acquisitions and deal flow has been the sticky wheel in my business for sure. I'm starting to see a lot more recently, but again, it's being clear on like, what is a deal? I don't want to just see another apartment. There's tons for sale, but what is an actual deal? And what will I be willing to do? So that also has had to change a little bit too. So, okay, ideally I want to have 75 doors plus. Ideally I want to have this. And I've changed it a little bit where I've seen opportunities with like a smaller apartment that we just closed last year that was in a B++, A- area of Fort Worth. And that one was just, it's filled with doctors, it's in an area, there's 5 hospitals nearby. So point is that deal was different than we normally do, but trying to change the criteria to look at maybe 48 units or 52 or things like that, if they're all within 30 minutes of each other in Dallas Fort Worth, because those will have the meat on the bone and the cash flow that I want. It'll be a pain in the butt to acquire, but that's where I can find a deal. So I've had to adjust the acquisitions a little bit to be able to get into some deals.
Great. So we have about 5 minutes left. What recommendations do you have for our audience moving forward?
Recommendations just overall.
Overall market, open mic.
Overall, so those, I guess, looking to jump from single family to multifamily, I would say don't overthink it. I haven't looked back since. I think it was a great move. I'm not saying drop single family altogether, make a transition, but just the economy of scales and the fact that you don't have to be doing 100 single families, you can do, one multifamily that has 100 units, is huge. And then as far as the market and kind of where we stand, be careful what you get into and the price you're paying. It's still real estate. I still feel you make your money on your buy. So, take, especially in multifamily, like Katie mentioned, as far as reserves, and we don't go into a deal unless we know everything, exactly what it's going to cost us. Our insurance, our taxes is kind of, can't know exactly, but you can do the research and have a good idea of what it's going to be. Same with payroll and just all your expenses, know them to the T. Don't use, don't use those at all. Those will kill you, especially right now in this market. That's it. I mean, I'm still very strong on this market, especially multifamily in the industry. So don't be scared of getting into it. Just be careful.
I'll offer up a couple of things I think are important. First is on the acquisition side. It's a little bit different on multifamily than it is on single family for sure. But one of the things that I think is a common misconception is that what you're buying using, meaning it's not just price on multifamily. More often than not, we are not the highest offer on the deals we are getting. We are the sure thing. And we've positioned ourselves in a way to make the seller know and be aware that we're the sure thing. What they don't want to do is go through 3 months of due diligence, another 2 months of legal and all this crap and LOIs, and then it falls out. They don't want to do that. They will come down on price and take you if they feel more confident about your position and being able to close on time and actually close. So think about that a little bit in terms of your offer strategy on how you're representing yourself. On the back side, something that I think, again, if this is really a panel about transitioning, the other thing that I think is very, very different is just managing the property. Being a single family residential asset property manager is very different than multifamily. You are really, truly running a business when you're on the multifamily side. Generally, the maintenance is more of a pain. Generally, because you get these things that can happen that are like this meta layer, like you can get group thinking that starts to happen amongst tenants, and they talk to each other. Next thing you know, you've got like 10 to 20% of your tenants all demanding something from you. And I'll be honest too, and this is not a knock on any generation, but like the current younger generation coming into multifamily is very entitled. They're like, oh no, I need you to do this for me. Like, come change my light bulb, and I'm like, no. So you have to really be prepared to do that. And why that's so important, particularly if you're doing a value add and a flip with a 5-year strategy, you have to get this property stabilized. You have to get the rent rolls where you said they would be in your pro forma. You have to keep your expense ratio at a certain level. You have to do all these things that you contemplated 3 or 4 years ago or longer. And if you're not in a position to manage that and actually create this and manifest this as a reality, it's going to be very difficult to sell the property, and you haven't fulfilled your investment mandate, which you pitch people on in the beginning. So my biggest advice, I think, would be really be thinking about how you're getting into deals. It's a little bit different. And then really be prepared to manage a full-on business in a very different world if you're going to fulfill your investment mandate.
Kaylee, what recommendations do you have?
As far as the panel's about growth, right? So as far as growth, if you're going from single to multi, I think a big thing when it comes to growth is mindset. Something that it took me about a year in the beginning to get over myself, if you will. So it's about the team. It's not about me or like, I know that my face is all over stuff, but it's really to get people into this so I can push these women forward and have their faces be out there. So I got to do it in the beginning. But as far as putting your team together, people that have different skill sets, they have a lane, respect that lane, let them stay in their lane, stay out of their lane. A big, huge thing with growth is not only relying on team players. So everyone, me in the beginning, the growth that I did have was for me going, All right, what can I do? Can I raise money? All right, what can I do? Can I go find a deal? I'm just going to do one piece of the puzzle because it took me 6 months to buy 2 small deals by myself. And it took me 18 months to get into like close to 700 doors by teaming up with other people. So that as far as growth, being focused on the team, being a team player yourself is very important. And also when it comes with that, part of the growth and team player mentality is being uber professional. That's something that when you're transitioning from single to multi, being professional, separating some of the work, trying to respect people's time, really having a way that you speak with people where you respect them, always give before you take. I don't know, there's a list of things, treat people how you want to be treated that come along with being a good, solid professional individual. No drama, being calm, level-headed, solution-focused. So all those things I think really feed into, if you're going to make that transition into multifamily, you got to work on that stuff first. So.
Awesome. Thank you so much. We're a little bit over time, but real quick, can each of you share how people can get in touch with you if they'd like to invest with you or just get in touch with you in general? Social media, email, however you'd like to be contacted.
Oh, sure. So you can go to my website, theapartmentqueen.com. There's a bunch of stuff on there. You'll probably get overwhelmed. If you go to the top tab, there's a tab for the fund waitlist. If you're accredited right now, there's a tab for if you have a 1031 exchange, we can roll that into an apartment deal. And there's also a tab for if you're not an accredited investor to get on the waitlist for a future 506B deal. That's probably the best way to get a hold of us and get on the list.
All right, this one's for Linda. This is just use your Think Realty app to get a hold of me. There we go.
Awesome.
Oh, yeah.
There we go.
Here we go.
Yeah.
I'll go back to Kaylee's way, just in case somebody doesn't have the app. But website is Elevate CIG, stands for Commercial Investment Group, elevatecig.com. Bunch of information on there. If you want to shoot me an email, it's George or spelled Jorge. I go by both. JORGE at elevatecig.com.
Awesome. Thank you so much. All right, everybody. Thank you for joining us.